So we're going to talk about everything that can go wrong and all the different exit strategies. Let's just list the 4 different things that could happen. Something could go wrong with your personal economy, like you can't keep paying premiums. Something could go wrong with the macro economy, like we go Red Dawn, Doomsday Prepper over here. Something could go wrong with the insurance industry / your particular company, or something could go wrong with these lenders, or there's some crazy disconnect between lending rates, borrowing rates, and the growth rate. I'm pretty sure we covered everything. That's what we're going to talk about in this video. So let's talk about what happens if you can't keep paying. Hopefully you saw in the last video how this helps now and later, that pretty early on in the policy, you start to hit that positive arbitrage to where even if you needed to borrow against the policy itself to max fund it, you could. What we didn't talk about in the last video is that you have a certain amount of flexibility. Underneath the video here, there's going to be a couple of supplemental links. One is whole life flexibility that shows you don't always have to pay the maximum if you don't want to, but if you could borrow against it at maximum at positive arbitrage, I don't know why you wouldn't, but just in case you don't, the whole life flexibility would be good. And also the article about using an RPU, doing a reduced paid up. We'll just show it here. What is the reduced paid up option? And it's one of the whole life's non-forfeiture options. This is installed on every single whole life policy. So you can do this for any whole life policy. And this article will talk to you about what that is. But you can basically stop paying anytime after the 7th year. Again, if you could borrow positive arbitrage, I don't know why you would, but you can. Let's say that there's some kind of temporary disconnect, kind of like there was when Universal Life came out. What happened was people cashed out of their whole life policies because they weren't catching up as quick as these new Universal Life policies that were just paying the stated interest rate. And looking back, that was probably a mistake, because what they could have done is they could have just borrowed against the whole life policy again at 95% and started a new Universal Life if they wanted to. And some people didn't even do that. They just started like passbook savings accounts that were paying 10 or 11%. Well, you could have borrowed against the policy itself to get into this higher paying investment, whether it's an insurance policy or a savings account. I'll tell you another story of non-callable investment grade bonds. So Guardian, one of my alma maters, in fact, when I really got into whole life, they had a great story about something they did during this time where, as they were getting in the new premiums, non-callable bonds are bonds that can't be taken back. It's like almost like the issuer of the bond can't refinance it. And so they started gobbling up these non-callable bonds, even though they paid a slightly lower rate. Like maybe they could have got a bond paying 20%. They took a non-callable bond paying 15, 16, 17%. And they bought as many of these as they could during kind of the peak of the interest rate spike. And when you look at it, interest rates usually spike for a little bit and then they kind of come back down. So Guardian took full advantage of this, just like you could on an individual level, by borrowing against the policy at 95%, gobbling these up. And then what happened is when interest rates came down, they could have just kept it on their balance sheet and it started earning that coupon, but instead they sold them back at a huge capital gain. And they actually got some special private letter ruling from the IRS, some special exception that said that they didn't need to pay it all in one just monstrous dividend. They were able to pay, spread those gains to policyholders and a dividend over 5 years so that they can be competitive. That's a cool story about whole life. But again, you could do this on a personal level. If there was some disconnect in rates temporarily, you could borrow against the policies itself, get into this higher yielding investment. Even if there was a disconnect in rates between what the banks were paying and the policy loan, usually the policy loan and the dividend are pretty much intended. You could cancel a line of credit, refinance whatever your balance in your line of credit back to the policy loan, get something close to a wash loan, borrow against it, invest in this outside situation, even if it's temporary. And then as you reap the spoils of that, whether you're just collecting interest off these bonds or whether you're going to sell them for a capital gain, go ahead and make the policy whole. And by then there's probably no disconnect again. Again, you can do this for 95% of your cash value. Why not keep one little finger or one little toe in the policy? Because net, it's a good thing. Plus you have all this protection. All right, let's talk about the macro economy. So what happens if the whole world comes to an end, all this money printing and craziness and whatever, the secret societies can't keep it going and the whole world collapses and we go doomsday prepper, Red Dawn? Let's face it, did it really matter whether you put your money in whole life from a mutual company or a Vanguard dividend appreciation fund or some kind of gold ETF, or even having an apartment building half hour away and you have a paper deed to real estate? All that stuff is paper and it's going to be good for about that. Like basically you could roll it up and light it on fire to start your doomsday prepper campfire, or you can use it as some sort of hygiene product if you ran out of that stuff. But it's really not good beyond that. Can we agree on that? I mean, again, even if you own real estate, which is a hard asset, but you just have a piece of paper, you're going to go down there and go, okay, everybody get out. This is mine. No, you better have some of the non-precious metals, like, right? You better be able to do that to protect your doomsday prepper camp, and have some other non-precious metals like canned food and a 55-gallon drum full of water and whatever else. But again, it didn't matter where you put your paper assets at that point. I don't think we're going to go there anytime soon. At least I hope not. But let's face it. If you saw the writing on the wall and things were starting to get ugly, couldn't you just borrow 95% of your cash value to outfit your doomsday prepper camp and get all your precious metals and non-precious metals and anything else you thought was going to be valuable? Couldn't you? And couldn't you keep that 5%, that toe in the policy, just in case things weren't as bad as you thought? And then you could at least have this thing that was going to help you with your liquidity, not to mention there's a death benefit of chronic illness rider. Couldn't you do that? Like most people think it's okay. Our insurance company's safe. And by the way, I wrote an entire article about this, and you can find it at bankingtruths.com/safe. When you go to bankingtruths.com, safe, you'll see it looks like this. You'll see FDIC, and FDIC makes people feel so good. It's just those warm and fuzzies of the FDIC. But again, let's face it. If Chase, Bank of America, Wells Fargo, they all go broke, and you need to go, all right, FDIC, I want my $250,000. What is $250,000? Like, is that worth anything? Can you buy a loaf of bread with it? Is it like a gazillion Turkish lira? Like, is it even worth anything? Probably not. But there is something that the life insurance industry has. It's called the National State Life. There's a national and a state life and health guarantee association. It doesn't work exactly like FDIC, but you can read about it. I don't think that's going to be an issue. Why? Because there's only been two major, what I'm going to call near failures during our time. And let's just talk about them because it'll illustrate how safe life insurance companies are. Before we go there, let's talk about the Great Depression. How many insurance companies went broke? None. But how many banks went broke? Lots of them. Why? Because they were loaning out $10, $20 for every dollar they had on reserves. And life insurance companies have more conservative standards. They have to reserve a buck and a nickel and a buck and a dime for every dollar of liabilities they have outstanding. So there was no FDIC back then. Guess who bailed out the banks? Life insurance companies. They had all the money, right? That was pre-FDIC. So life insurance companies, the same thing that we're talking about investing in now, has basically all the characteristics of the thing that gives you the warm and fuzzies, the FDIC. They were the FDIC back then, but I digress. Going back to Executive Life of California, 1980s, huge growing company, huge. And part of the reason why they were growing is their policies look so good. And if you looked in their balance sheet, which we do, by the way, with our clients, when we look at different insurance companies, we actually look and see what they're investing in and how they're investing. So this company invested a lot, over tilted their investments to something called high yield bonds. If you remember the S&L scandal. Well, nowadays they call them junk bonds. In fact, there's one ETF, if you type in JNK, it's a high yield bond fund, but they got the symbol JNK. After this scandal, the S&L scandal, everybody started calling them junk bonds. They pay more, but there's more risk. And when that rug got yanked out from under Executive Life and they were holding all this stuff, they were deemed to be insolvent. So what happened? Well, a bunch of other life insurance companies bailed them out. How? They started a company called Aurora Holding Company. It was just a brand new life insurance company. They all pitched in money. They absorbed the liabilities, the policies, and they service these policies with that money. And what's interesting is even today, Aurora is still in business servicing these policies. And since these policies were sold in the 80s where interest rates were so high, the guaranteed rates were even higher than today's current rates. Forgetting today's guaranteed rates, their guaranteed rates were higher than what you can get today from like the best performing policies. And they're still being serviced. Those promises are still being kept. No insurance customer has ever been stiffed by a defunct insurance company. It just didn't happen. Let's talk about why. Why did these companies bail out Executive Life of California? Well, think about it. If Executive Life of California goes down, does anybody trust the life insurance industry after that? No, it's over. They all go down. But it turned out that AIG policyholders never lost out. In fact, I was servicing a client who had a bunch of old AIG whole life policies. The old whole life policies before they were a stock company, they were paying dividends. They still continued to grow these policies and they never missed a beat. So AIG didn't renege on any promises, but let's talk about who bailed them out. Was it a collection of insurance companies? No. Why? These 4 words: too big to fail, right? And so they needed the government, which is, I used to joke in 2009, 2010, AIG stands for Americans Insured by Government. The federal government needed to step in and bail out AIG because they were so huge, even all the insurance companies put together couldn't bail them out. Now, why did the government do this? It's the same reason as Aurora Holding Company or whatever. If the government lets AIG fail, Western civilization as we know it becomes unraveled. So it's like third world countries where people don't trust the banking system, people don't trust insurance, and then it turns into the wild, wild west. And obviously the federal government has a vested interest in keeping our civilized way of life intact. And so they bailed them out. They bailed them out for a profit. And AIG eventually paid the government back, again, taxpayers back with the profit, and their insurance, their life insurance business never missed a beat, and the rest of their insurance business is totally intact. So hopefully that helps as far as how safe it is to invest in life insurance. Let's talk about the lending side of things. People ask me, well, what happens if all these cash value line of credit banks, what if they go broke, or what if they exit the business? Well, let's think about it. They're loaning you money. So if they go out of business, I mean, best case scenario is now I don't need to pay it back. Somebody's going to step in and want them to pay it back. But I mean, if they went out of business, technically that could be good for you. Don't count on it. It's never going to happen. So I know that was a lot. It's good for me to cover everything because I know everybody has concerns about this. But I think it's good to keep your policy in force for this kind of wait and see approach, regardless if there's a better investment opportunity or you think the world's coming to an end or whatever that is. So hopefully this helped, and definitely check out the supplemental learning material below.